Let's go back to a specific moment. You remember it? Maybe it was a phone call. Maybe it was an email. Maybe it was sitting across a desk from someone in HR, and they told you the number. Your first real salary. Your first grown-up, full-time, benefits included, direct deposit every 2 weeks' salary.
And you felt it, that rush, that feeling of arrival, like everything you worked for, the degree, the internships, the applications, the interviews, it all landed in that one number.
And you did the math immediately. Everyone does the math immediately. $55,000 divide by 12. That's $4,580 a month. You started thinking about your apartment, your car, what your weekends were going to look like, what your life was going to feel like.
And then the first paycheck hit, and the number was nothing like what you calculated.
Nothing like it.
And nobody warned you. Nobody sat you down before that first paycheck and said, hey, here is what is actually about to hop into that number before it reaches your bank account. Here are all the things that are going to take a slice of it. Here are all the decisions you are about to be asked to make that you have no context for. Here is what this money actually means in practice versus what it sounds like on paper.
And that gap between the salary you were offered and the financial reality of actually living on it, that gap is where a lot of young people's financial lives start to go sideways before they even really begin.
So today, we are filling that gap. Everything nobody told you about your first salary, the taxes, the benefits, the hidden costs, the psychological traps, all of it.
Let's start with the most immediate shock, the one that hits before anything else, the paycheck.
So you get offered $55,000. That feels like a very real, very specific number. And in a technical sense, it is. That is what your employer has agreed to pay you over the course of a year. It is called your gross income, and it is almost meaningless as a number for planning your actual life.
Because what lands in your bank account is your net income, and the distance between those two numbers is significant, and it is not random. It is a collection of very specific deductions that most people have never had to think about before their first job.
The biggest one is federal income tax. And the way it works is not the way most people think it works. A lot of people believe that if you're in the 22% tax bracket, you pay 22% on everything you earn. That is not how it works.
The United States uses a marginal tax system, which means you pay different rates on different portions of your income. The first chunk is taxed at 10%, the next chunk at 12%, the next at 22%. You only pay the higher rate on the dollars that fall into that bracket, not on your entire income.
So on a $55,000 salary, your effective federal tax rate, the percentage you actually pay across your whole income, is closer to 12 or 13%, not 22. The 22% is just the rate on your highest dollars.
But even at 12 or 13% effective rate, that is still $6,000 or $7,000 a year going to federal taxes, which is $500 to $600 a month that you absolutely cannot count on having.
And federal tax is just the beginning. Then there's state income tax, which varies enormously depending on where you live. Some states have no income tax at all. Others take 5, 6, 7% on top of what federal already took.
Then there's FICA, which stands for Federal Insurance Contributions Act, and it covers two things, Social Security and Medicare. Together, they take another 7.65% off the top of your gross pay, automatically, before you see a single dollar.
So add it up. Federal taxes, state taxes, FICA. On a $55,000 salary in a moderate tax state, you might take home somewhere between $38,000 and $42,000. Your actual monthly take-home might be $3,100 to $3,500, not $4,500, not even close.
And then before you even process that number, the day you start your job, someone from HR hands you a stack of forms and says you have 2 weeks to make decisions about your benefits.
Which is one of the most overwhelming experiences of early professional life, because you are being asked to make financial and medical decisions that will affect your entire year, sometimes your entire decade, and you have no context, no training, and approximately 45 minutes during your lunch break to figure it out.
Let's talk about the benefits decisions, because they are genuinely confusing and the stakes are real.
Health insurance first, because it is usually the most expensive and the most confusing. Your employer will likely offer you multiple plan options, and they will describe them in language that feels specifically designed to make your eyes glaze over.
HMO, PPO, HDDP, deductible, premium, copay, coinsurance, out-of-pocket maximum. These are all real terms that have real financial consequences, and almost nobody explains them in plain language to a 22-year-old on their first day.
So here is the plain language version. Your premium is what you pay every month just to have insurance, regardless of whether you use it. Your deductible is how much you pay out of pocket before insurance starts covering things. Your copay is the fixed amount you pay per visit or prescription. Your out-of-pocket maximum is the most you will ever pay in a year before insurance covers everything at 100%.
The decision between plan types basically comes down to one question: how healthy are you, and how much do you expect to use the healthcare system this year?
If you are young, healthy, and barely see a doctor, a high-deductible health plan with a lower premium might save you money. It costs less every month, and you just absorb the occasional expense when something comes up.
If you have ongoing medical needs, take regular medications, or just want the peace of mind of lower out-of-pocket costs when you do use care, a lower deductible plan with a higher premium might actually cost you less overall, even though it looks more expensive on the monthly line item.
And if your employer offers an HSA, a health savings account, alongside a high-deductible plan, pay very close attention, because an HSA is one of the most tax-advantaged accounts in the entire financial system. The money you put in is pre-tax, it grows tax-free, and it comes out tax-free when you use it for medical expenses. It is the only triple tax-advantaged account that exists.
And the money rolls over year after year. It never expires. A lot of financial planners will tell you that maxing your HSA before anything else, if you are healthy enough to handle a high-deductible plan, is one of the smartest financial moves a young person can make.
Then there's the 401k. And this is where a lot of first-time employees make a mistake that costs them real money, immediately, on day one.
Most companies auto-enroll you at a contribution rate that is lower than their matching threshold. So you might be auto-enrolled at 3%, and the company matches up to 5%, and you never change it. And you leave 2% of free money on the table every single paycheck for years because nobody told you to check.
The employer match is 100% return on your investment. There is no asset on earth that gives you a guaranteed 100% return. If your employer matches up to 5% of your salary, you should be contributing at least 5% from day one, non-negotiable.
And I know what the reaction is. I can barely afford my rent. I can't put 5% into a retirement account I won't touch for 40 years. And that feeling is real. The math of a first salary is tight. But here is the thing about the 401k contribution. It comes out of your gross pay before taxes.
Which means when you contribute 5% to your 401k, your take-home pay does not go down by 5%. It goes down by less because that money was pre-tax. You are saving money that would have gone to the government anyway. It is genuinely the most efficient savings vehicle available to you.
Okay, taxes covered, benefits covered. Now let's talk about the psychological dimension of a first salary, because this is where the really long-term damage happens, and it happens quietly. It happens naturally. It almost feels like success when it's actually a trap.
Lifestyle creep.
Lifestyle creep, also called lifestyle inflation, and it is the single most common reason why people who earn more and more over their careers somehow never feel more financially stable.
Here is how it works. Before your first job, you were a student, or you were working part-time, or you were doing whatever you were doing on a limited income. You had a baseline. You cooked most of your meals, you had a modest apartment, you were careful because you had to be.
Then the salary hits, and your brain, very naturally, very understandably, starts recalibrating. You work hard. You deserve a nicer apartment. You're a professional now. You should dress like one. You've been eating rice and beans for 4 years. You deserve to go out to dinner sometimes.
And none of those individual decisions are wrong. The nicer apartment might be worth it. The professional clothes might be necessary. The dinner out is a genuine pleasure, and there is real value in enjoying the money you earn. But here's what happens in aggregate. Within 12 to 18 months of starting a first job, most people have expanded their spending to meet their income almost entirely. The raises feel good for about 2 months, and then they just become the new normal. And the trap is that every step of the lifestyle upgrade feels justified. It feels proportional. It feels like you are simply living the life that your income level warrants, which is exactly what every advertisement, every social comparison, every cultural message is designed to make you feel.
Spend to your income. That is the default. That is what happens if you do nothing. And the people who end up wealthy are almost entirely the people who consciously refused that default from the very beginning.
There is a concept called the wealth accumulation gap, and it describes the difference between what you earn and what you actually accumulate. 2 people earning the same salary for 10 years can end up with wildly different net worths, and the primary variable is not investment returns or lucky stock picks. It is how much of their income they captured before lifestyle expansion claimed it.
The move, and this sounds almost too simple, is to decide what percentage of every paycheck goes to savings and investments before you decide what your lifestyle looks like.
Not after, before. When you get your first job, your baseline lifestyle is already established. You were living on whatever you were living on before. That baseline is the foundation. The question is, when the salary arrives, do you immediately rebuild your whole life around the new income, or do you keep the baseline roughly where it is and capture the difference?
Most people do the first. The people who build wealth do the second. And the gap between those two choices compounds dramatically over time.
There's also a specific version of lifestyle creep that nobody talks about, and it's the one that gets people the fastest. It's not the big obvious upgrades, the nicer apartment, the newer car. It is the invisible recurring expenses.
Subscriptions, memberships, convenience services, the meal kit delivery, the 3 different streaming platforms, the gym you joined but rarely use, the app subscriptions that charge you $12 a month and you've completely forgotten about, the food delivery habit that started as an occasional treat and became a 4 times a week reality.
None of these feel like financial decisions. They feel like small quality of life choices. But added together, they can easily represent $300, $400, $500 a month of spending that generates almost no lasting satisfaction and disappears entirely from memory within a week of the purchase.
Do a subscription audit every 6 months. Seriously, sit down, open your bank statement, and write down every recurring charge. The number will surprise you. The sum will genuinely shock you.
Okay, let's